Financial Planner. Follow us on YouTube.
Hey, thanks for having me.
Hey, thanks for being back here. And let's start off with what has been happening in the economy here, because we see the stock market all-time highs. I mean, it just continually pushes up. The housing market here in the United States is hitting new highs. Unemployment is very low here, and they're making it seem like everything is absolutely perfect. But again, we know a lot of these numbers are manipulated. We know the central banks are involved. We're also hitting over $20 trillion in debt. From your vantage point and from everything that you've been researching and what you do here, when you look at the economy, how is the economy doing?
Dave, excellent question, because the difference between the real growth of the United States economy and the growth of the equity markets in the United States is different. The United States is a well-developed country. Most of the people in the United States own the basic necessities and the essentials in life. And they either own a home or rent a home, but the housing market is built from, modern homes. And the same goes for cars. Almost everyone in the U.S. either drives a car or has access to a car. Electricity is the same thing. People take this for granted, but in the rest of the world, Dave, and I know, because we've seen other countries in the world, people do not live like they live in the U.S. And the reason I'm saying this is because between 2009 and 2017, while the central bank in the U.S. eased monetary policy by lowering interest rates to zero and then negative rates and negative real rates, and then eased monetary policy by buying bond purchases and helping banks by funding their liquidity, etc. Their objective was to stimulate the economy into growth. But when a well-developed country doesn't need to grow naturally, people don't need new cars or new housing, or everything is already there for most of the demographics, you're not going to see growth. And so what they created is artificial growth. They must do it, otherwise we'll have a debt deflation because of all the excessive debt. So what you saw is a huge pile of debt piling up, and then it needs to this new credit needs to flow somewhere. But the private sector didn't want to borrow. You and I and the middle class, we look at, and this is how the middle class or people who are in need of loans think. If the Federal Reserve is easing and lowering rates, why would you borrow now if you know that next quarter they're going to lower even more, and next quarter even more? You're going to wait and wait and wait, right? And so most of the analysts and the gold bugs who predicted that easing would create massive inflation did not fully take into account that when you ease monetary policy, you create a situation where the market gets the signal that something is wrong. And when something is wrong, why would you borrow, right? If you're going to borrow and buy a house but you think the house is going to be worth less next year, you're going to hold back. And so people were buying stuff that they know, would it doesn't matter if they go down in price. So people took out a lot of car loans because, cars go down in price no matter what. But if there's an attractive rate to loan, you're going to take out a loan. So car payments are at a all-time high. Student loans are at all-time high. Credit card loans or credit card revolving debt is at all-time highs. So the consumer used credit for not to grow his own wealth and not to grow his small business. Who took advantage of all these all the loans that are available, all the cheap credit? It was institutions, it was pension funds, it was the large corporations which borrowed at very, very silly low interest rates and bought their own stock, propping up the market. So that's how you create an artificial market, and that's how you enrich the rich while impoverishing the poor. So this 9-year period, what it did was create a wealth disparity, and you can see it in America right now. If you take a road trip, you'll see the disparity in the states. If you look at the different zip codes in metropolitan cities, you really see it's like two different countries within the same city. And if you go to the cities that you don't see on TV and you really dive down into America, it's a situation where one person, if you take a cut of 1,000 people, one person out of 1,000 has more wealth put together than the 900 of that 1,000 people group. There's a huge wealth disparity, and that's what the last 9 years have created. Now, since 2015, they've tried to reverse the books, but the public wasn't participating. So they started to tighten, but the public did not feel like tightening is signaling getting back to normal. But once Trump got elected, that was a huge signal that confidence is starting to come back. Usually presidents, when they come into office, because they know that their likelihood of impeachment at the first year is very low, they start with all the tough decisions, and they go after the things that will not interfere when they want to get reelected. So they wait for all the good stuff for years 3 and 4 so they can get reelected. Trump is doing the opposite. He's doing all the good stuff he's doing right now. So he's going for tax cuts, approved. Next, he's going to go for the infrastructure boom. Now, an infrastructure boom in America is something very positive for the economy. And so you see consumer confidence in all-time highs. You see small business hiring for the first time in years. You see many good things happening with regulations. And I think the biggest thing is it's a natural growth that's happening at 2 or 3%, and not this incredible 20% that you see in the stock market in 1 year. So that's unsustainable. But the U.S. is growing at about 2.5%, 3% a year, and that's due to the fact that the millennials have surpassed in numbers the baby boomers, and the millennials do need to create lives for themselves. So home, housing, cars, vacations, etc. They're going to start doing that. So you're going to see real growth in America going forward, but with this overhanging debt cloud. So you got two converging forces that are going to be needing to come to terms. And what, in my opinion, if the infrastructure boom is going to get approved, then Trump's approval ratings are going to be high enough to where he starts tackling the rough stuff, and the rough stuff is entitlements and the age of retirement in America, and what's going to happen with all the debt that's in the economy. So a few rough. 2018 is a year when you can really still make large gains with the fake economy. And then it's going to probably go into some sort of a slowdown and a recession for a few years as all this unwinds. But then you're going to see growth again. So a very interesting time in the U.S. and what's going on with the economy. What is most important to understand is the pressure now is inflationary and not deflationary. And so with the Fed raising rates, what they're trying to do is make sure the economy doesn't get overheated, because in the United States, the natural unemployment rate is not as low as it is today. If you don't follow the official, if you follow some alternative unemployment figures, they're still fairly low. And so you're seeing a very overheated economy, and it can get very inflationary very soon. In fact, you're seeing gold soaring, silver soaring, copper soaring. Wealth Research Group just started covering its first copper company in 2 years. We've never covered a copper company. It's up 50% today. It's called Cucho Copper. And you can go to wealthresearchgroup.com / inflation and see why copper is the number one performing metal when inflation starts triggering. And so, Dave, bottom line, the U.S. economy is entering inflation right now.
So, I mean, at the same time, when you're saying that, the Fed is raising interest rates, they're also unwinding at the same time their balance sheet, at least they're trying to, but it's very small at this time. But as they raise the interest rates, this could, create other problems, because as the interest rates move up, you have those people who, like you said, the millennials, it's going to be a tougher time purchasing a home. If the interest rates go up, it's going to be a tougher time getting an auto loan. If the interest rates go up, it's going to be a tougher time getting a student loan for those, students. I mean, so there's, pluses and minuses here. And if they raise them, and we saw this back in 2008 when they raised them, actually before 2008, they raised them, they were continually raising them. And then all of a sudden, things started to break down. Do you see the same thing happening?
Sure. So two things are important. That's a great question. So what institutions look at is what can they earn in terms of dividends on the S&P 500 versus buying the safe haven bond, which is the Treasury. So every time that the S&P 500 dividend yield, which is now at about 1.88%, every time it's lower than the 2-year bond, which is now at 1.92% as we're doing this interview, every time that happens, the stock market starts to slow down, because pension funds, institutions, etc. say, okay, if I can earn 1.88% with stocks that are very expensive, or I can buy a treasury for 2 years and earn more, I'm going to opt in for the bond. And so when they raise interest rates, what they do is they speed up the top for the market. On the flip side, raising interest rates signals to the market everything is going back to normal. The economy is growing, buy stocks. So the market is getting mixed signals. And so what balances this out is whether or not the synthetic interest rate, or what we call the Fed funds rate, what the Fed controls, the fake interest rates for the entire economy, if that is higher than the 5-year bond or the 5-year treasury, currently sitting on 226, if that is higher, we always hit a recession. Go back, do a comparison between the 5-year and the synthetic interest rate. If the synthetic goes above the 5-year treasury yield, the economy stalls, because that signals to the entire world that, hey, I can get a better interest rate with the synthetic Fed fund rate than with lending to the U.S. government. And that always creates a recession. Now, we're about 1 year away from that happening. And so the market obviously always tops off a little bit after we hit the official recession. And so I see the market topping off in about a year from now. And I see these two numbers going hand in hand with a recession. We're well due for a recession, and that's fine. The unemployment rate is so low that you can't continue to hire. There's no businesses cannot make better margins by hiring people, Dave, right? Because you gotta think revenue per employee. You can't keep hiring people. So there's a limit to that. And when you can't hire any more people, you're going to start laying off people. And so the recession is very, very near, about 1 year away. You can't call it to the day, and you can only predict that when these numbers historically, the Fed fund rate and the 5-year bond, are hand in hand the same level, that slows down the economy. So if you're asking me what's going to happen, when is it going to happen, look at those two things, and Wealth Research Group is going to watch them and cover them like a hawk in the next year, because that's what's going to signal to, the top for the market. Now, what is exciting is that in 2016, when you saw the S&P 500 correcting, not topping and crashing, but correcting 11%. So we're not talking a huge correction like I think is coming, where it's going to be like 20-25%, maybe even 30%. You saw all of the stocks that are used for hedging, so the gold stocks, the silver stocks, etc. They go on an 8-month run in 2016. And I think in 2018, you're going to see a lot of institutions starting to hedge their long U.S. equities portfolio with gold and silver stocks. Again, you can already see it's starting. And the reason I'm saying this is twofold. One, gold has bottomed in December 15th of 2015, the first time the Fed raised rates. It's been up from that point until today about 30%. The gold shares have not bottomed off at that date. They've had a bloodbath year in 2017. But around 80 weeks to 100 weeks into a gold spot price bull market, the stocks themselves, the gold shares, begin to go and get into these more parabolic moves. And the reason is all the participants in the market start to see that many of these companies have economical projects, and so they reprice them. And you can see that with mergers and acquisitions. If big companies come in and swallow up all companies, that's the beginning of a gold stock bull market. For example, the companies that I mentioned, Kucho Coppers, the reason it's up so big today is because Wheaton Precious Metals, formerly known as Silver Wheaton, the reputation of this company is that it's the best business model on the planet. They took a huge position and invested in Kucho Copper. That's exactly what we want to see in the gold junior sector for it to light up. The other thing that's important is you saw Bitcoin's vulnerability in the last month, where it's down 50%, and then recovering, etc. But the vulnerability of it showed participants in the market that if they want a speculative portfolio, they should diversify out of Bitcoin and into either other altcoins or into the gold and silver market, or other commodities which are far cheaper than cryptocurrencies right now. So you're seeing a lot of changes going into how people allocate their portfolios in 2018.
To move forward with the gold discussion, the BRICS, they're looking to create a gold trading system. And from what we're seeing is they want this to go online in 2018. We're also seeing inflation now. Now, we have both of these things happening all at the same time. Now, do you think that the BRICS, where this is China, Russia, and the rest of the countries, they're looking at this, does this seem to you that they're trying to take control of the gold market? Because remember, China, Russia, and many of these countries have purchased a lot of gold. Do you think this is their move to take control of the price discovery of gold?
What I think for sure is that these countries know that the US dollar is not a viable reserve currency anymore. It's acting like a kamikaze plane going down. It had its worst year in 7 years in 2017. And so when you own so much treasury like China does, and like Japan does, and like other countries around the world do, you cannot keep buying treasuries when the U.S. is not acting the way it did for the past 30 years. So Trump is a different animal than what they're used to. He's doing things in another way. And so they do not trust that they'll be treated the same way they did with other presidents, which are presidents of the deep state. Trump is trying to create a different type of paradigm. And so they cannot trust that he will play along in the game that has worked thus far for these countries, where they buy the debt and then the U.S. keeps, the trading with them in the same way, because he's trying to change a lot of the things that have been going on for decades. So what they're doing is they're trying to create a new system that will work for them because they know that their economies demographically and in credit ability are getting better while the U.S. is standing still. And so these countries, you mentioned Russia, China, and India. These are three countries that have a long tradition of backing their currencies with gold and silver. There's no reason why they won't do it in the 2000s and in the 21st century. China is going to be one of the biggest economy in the world by 2025 to 2030. So obviously, a dollar system is not where they want to take the world. What's going to happen is we're going to see a violent shift in the next few years, and I've talked about this a lot. The average U.S. citizen has got to come to terms with the fact that his ability to access credit is going to be very limited in about 5 years, and therefore the amount of debt that people have and the lack of savings that people have in America, that's going to come to a screeching halt at some point, at some particular moment, and from there on, the paradigm shift in the mainstream media and everywhere else will be into panic mode, and people are going to start, especially in the United States, to understand that what they've had until now was the luxury of having the reserve currency of the world at their disposal for for good and for bad, and they're going to be left only with the bad. They're going to be left only with the debt and how to resolve it, and they might go into a scenario where they look like Japan, where they can't get rid of that debt for 2 or 3 decades, just hanging over their heads. It's a very rough situation, and the more these countries stem away from the dollar, the more it's damaging for citizens of the United States. And obviously, I'll put Europe at the same basket because the euro is very much influenced by what's going on with the United States.
The paradigm that you were talking about with Trump, where he's doing things differently and, countries don't trust him and they're moving away from the dollar, his paradigm does not include the dollar being the reserve currency anymore.
What he's trying to create is an economy that is more self-sustaining. So in other words, he's trying to limit globalization into the United States. So entrepreneurship will not get outsourced outside the U.S. That's what's been going on for 2 or 3 decades, where you see headquarters of large companies inside the U.S. because you got a lot of human skill in the U.S. with when it comes to their business savvy. So you see, for example, Johnson & Johnson, Procter & Gamble, Coca-Cola, all the major headquarters in the U.S., but all the operations are outside the U.S. And what he's trying to do is trying to bring home jobs, trying to bring home more capital by doing tax cuts and building the United States as its own self-sustainable economy. It's been tried many times before by many other presidents. The intent is good, but the consequence is horrible. China was the world's largest country, largest empire by far, about 700 years ago, when they decided to take all their wealth and lock it up, all their secrets, all their trading, abilities, and put a wall, an actual wall on their country, which Trump has proposed as well. That has not been favorable to them. Once they did that, they cut themselves from the rest of the world, and they went on to become a communist country like 500 years later, and a very poor country. Closing down borders is not the right strategy, in my opinion. And Trump has got to realize also that jobs are not coming back. Automation is coming, and he needs to prepare citizens for how to have a job in a world where jobs are becoming more scarce. And he needs to navigate the U.S. into the fields of the future and not the fields of the past, like manufacturing. Because those jobs are not going to come back to the U.S. unless you're talking about the high quality manufacturing that the U.S. can do that other countries cannot do. Dave, it's a very unique world that is changing very fast, And in my opinion, the underlying theme, if you hear nothing else from this interview, is that you have got to find out the skill that you have that is unique to you, and you can do it at a very high level going forward. And that's where you're going to excel at. You can't wait for the government, and you can't wait for the president to navigate your life for you, because he can do many mistakes, and he's not there in 4 years. You need to forget about the government in terms of how you run your life and how you run your finances. You need to focus on your skills and on your portfolio. And the biggest thing right now is that after 9 years of a long U.S. equities bull market, you're going to see changes right now. And what the U.S. has managed to do is alienate the U.S. dollar from the rest of the world. That's why you saw it suffering from its worst year. 2017 was a very bad year for the U.S. index, and that's coming after a 35% bull market in the last 6 years, which obviously corresponded with a gold bear market. And so right now you're seeing that trend reverse. Gold is entering a bull market, a very healthy bull market, and the dollar is going to go into a bear market. And so in a bear market U.S. dollar economy, you can make a lot of money, and that's what you need to focus on right now.
Is this why we see China creating the petro yuan right now, to give other countries a chance to, pay for, the natural resources, not using the dollar, to move them away from the dollar?
Exactly.
When you say that, that people are going to have in 5 years, people are going to have a very difficult time getting credit, why would they have a difficult time getting credit? What would be the reason for that?
The U.S. Commercial banks can now use the fact that the Federal Reserve stands behind them and can originate credit for the U.S. economy and for the United States government at will, basically. They have a printing press. They have the power to create currency because the rest of the world needs that currency as well. In other words, if a small country like Latvia was trying to issue currency and spend it into the economy by way of selling their debt to foreign countries, those foreign countries would not fund as much debt as the U.S. can fund. The U.S. funds a lot of debt, and in return for exporting these U.S. dollars abroad, they get tangible items shipped to the U.S. And so they fund with debt, with cheap debt that they can create out of their computer systems. They fund the lifestyle of the federal government, which is always in deficit. That will not sustain if the world moves away from a U.S. dollar standard. You saw that in the UK when they had, when they had the reserve currency of the world, excuse me, until the 70s. And then you saw, in major cities in the UK, the power out. People didn't have, in the UK in the 70s, people didn't have enough money to pay utilities. That's what happens when an empire loses its reserve currency status. It has dire ramifications. You can't use credit anymore in the way that you did. It's so fundamental to the way of life that people, don't even factor that in. But when a government runs a $600 billion defense budget, which is all deficit, and now they got to make cuts, that deters their security, that deters the amount of soldiers that get salaries. They need to cut back on things. It's a whole different ballgame.
So what do you think is going to be the reserve currency? Do you think it's just going to be one currency? Do you think it's going to be multiple currencies? And how does cryptocurrency play into this? Do you think that's going to be part of it?
First of all, no country in their right mind will choose a yuan-backed reserve currency. China is not an exemplary economy for stability, so you can forget about that. The world is moving into a much more global and international realm, and so if you're asking me for a general theme as to where the world is moving, with regards to a more streamlined economy as a global village, it's going to go into some sort of a global currency that is much more interchangeable for all people around the world. So if you are doing business internationally, you won't have to trade within these national currencies, which, as you know, about 120 of them you wouldn't even want to touch because they're part of countries that are very unsustainable. And so you're going to see, and this is a tough process, and obviously it's a very complex process. So I don't know much about it because it's going to be constructed in closed doors at meetings of the G20 and G7 and the UN, etc. If governments are going to be the determining factor, and if there's going to be a real revolution of our way of lives and how we transact with each other, it's going to be part of these new cryptocurrencies. But right now, what you got to do is view cryptocurrencies as startup booms, startup companies or tech companies, and nothing more. You can't view them as things that have investment value. They only have speculative value right now. Even the more the more established ones are very speculative still in nature. Bitcoin is here to stay. It's not going to vanish or something like that. But the entire sector is very speculative. It's very natural for a long bull market in stocks to end with a speculative era. And instead of going into the Nasdaq and speculating with tech stocks, people are speculating with cryptocurrencies. It's very natural what's going on right now if you think of how bull markets usually end. And this is what's going on right now. If you're willing to understand that these are speculative vehicles which you can make an insane amount of money with, then your head is in the right place. But if you think about Bitcoin as digital gold, you're mistaken. There is no connection between the two, and they are not safe havens. They're speculative gains vehicles. So in 2016, 2017, for example, Wealth Research Group covered Bitcoin at 400. It went to 19,000. It covered Ethereum at $12. It went to over $700. Dash at $30. It's over $1,000. Monero, Steam, Litecoin at $20. It's over $340. Ripple, 3 weeks ago, Dave, at 27 cents. It's over $250 right now in 3 weeks. And right now we're coming out with our top 5 new cryptocurrencies for 2018 this Friday on the newsletter, on the free newsletter. Obviously, your listeners can take for a test drive at our site. So if you understand that these are massive gains that you can create, you're in the right mindset. But it's very speculative, and most of the exchanges, Dave, are backlogged. If you try and buy some of these cryptocurrencies today, you're going to have at least a day or two of trying to verify your account. Then you're going to try and buy some of these cryptocurrencies. You're going to hit a wall where you're going to only buy like $100 or $500 worth. These are not the exchanges are so overloaded that you cannot buy large sums of some of these altcoins. That's why in 2018 you're going to see blockchain publicly traded companies coming in, because that's where there's not going to be any liquidity problem, and institutions will choose those over cryptocurrencies. The stocks, the companies are going to be the connecting bridge between whoever wants to invest in cryptocurrencies and whoever has larger sums of money. To give you an example, with Ripple, subscribers emailed us that they've turned $300 into $3,000 or $500 into $5,000, etc. But when we covered the first ever pure blockchain mining company that started trading in September, Hive Blockchain Tech, people emailed us that they've turned 10,000 into 80,000. So they were able to come in with larger chunks. And that's going to happen in 2018 as well. And we're actively looking for our next big blockchain companies that we want to cover at Wealth Research Group.
Now the central banks, they're also looking at blockchain, and I think they're very nervous that they're going to miss the boat like governments did with the internet, where they said, oh, the internet's not that big of a deal, social media is not that big of a deal. And then, alternative media started popping up, and they started to realize, like, oh, wait a minute, there's something to this, and we should have been involved and controlling it at that time, just like they controlled the 5 news organizations here in the U.S. and others around the world. And I think the banks, the central banks, are looking at the blockchain technology, and I think they're saying that, something, we can use this because we have Barclays, Credit Suisse, Canadian Imperial Bank of Commerce, HSBC, and many others, plus central banks, working on their own coins, like they're working on the utility settlement coin. And I think what they're looking...
Wouldn't expect less of them.
Yeah, and I think what they want to do, and of course this is what they've done with strip away electronics and blips and all that, zeros and ones. Look at the currency system right before the central bank came in, where they needed to pass a law to force everyone to use their currency system. What they did was they made the present currency system at the time in 1913, before that, very volatile. And they said, oh, we can control it, we can manage it, we can take care of it. And they might do the same thing today with certain coins that are out there, where they might say, oh, look, see how volatile Bitcoin is, see how volatile this coin is, let us manage it. We have, and already they have coins waiting in the wing. It's not like they have to develop them. They always have them. They've been working on them.
It's certainly a possibility.
Yeah. And I'm saying is I see them, moving into this realm because they're looking at it as, hey, we can use this system. I know a lot of people think that the government created this, or the central banks created this whole blockchain thing. But if they did, they would have been right out there in the forefront saying, this is our system. We're going to loan this with interest attached, and they would have a whole thing. I think they're coming in on the backside, not realizing what happened here. And I think they're trying to get in on it and take control of it. And if they do take control of it, I mean, this could be their worldwide currency that they could use, because they would.
The entire, when changes happen, when these kinds of large changes happen, the bad players in the market, the people that wake up in the morning and they're not like us. They're not regular people. They think in terms of dominance, and the politicians and the central bankers, they have a different viewpoint of the world, and a different viewpoint of people. They think that they're better. Not talking all of them. I'm talking the top echelons of government throughout history. If you are attracted into these sectors of banking and credit and of politics, you are in the business of controlling other people. And it's a sort of a personality that some people have, and they cannot but think in this line of thinking. That's how they are, hardwired. And so when these sort of changes or revolutions occur, they try to bank as much as they can from this revolution, from this crisis. It's one of their themes, Dave, as you probably remember. Timothy Geithner said, we cannot let a good crisis go away in vain. So they are like a scavenger hunting for crises, so they can present the public with new solutions that are furthering their agenda. And so, yes, there is a risk. There always is a risk with governments going in the wrong way. And if you're asking me whether or not the general public will prefer a cryptocurrency that has the seal of the government behind it as a reputable institution, or someone who no one knows who he is, like Satoshi Nakamoto, I fear that the herd, the general populace, they might opt in for a government-sponsored cryptocurrency because they don't know essentially what a cryptocurrency is. And so if they see something that has to do with money and the government, then they might choose this over the other. It's all about what the public is willing to accept at the bottom line. It's not something that's in my control or your control. We can do whatever we can, and this kind of a show where you're educating the public is exactly what what we can do, our part. But we need to also understand that there is a risk that when the banks start introducing their own blockchain and obviously their own database, their own internal currencies, etc., that there will be mass adoption of those currencies as well, and that is risky because you are losing a lot of the privacy that you have. If they control a database system where everything is digital, that it's very easy to punish you by either seizing your assets or freezing your availability to access your funds, etc. When you have paper money, you have other abilities. When you have gold and silver, you have abilities outside the system, etc. So it is risky, Dave, and we talked about all of these risks. We created an entire report about the risk of losing your privacy with cryptocurrencies at wealthresearchgroup.com/rocket. ROCKET. So you can access that, and we talk about that a lot because regulations are coming in 2018 to cryptocurrencies and to this entire sector. And you've really got to, watch what's going on in order to understand if you need to change anything with the way you're structuring your life around this.
Lior, thank you very much for being on the X22 Report Spotlight. Once again, how can people see all your work?
The best way is to go to Wealth Research Group, wealthresearchgroup.com, and then on the top menu, just click on Special Reports, and you're going to see a wide array of PDF files that cover a lot of the topics we cover today. So it's natural resources, and it's anything that has to do with the big picture economy and cryptocurrencies as well, and also eternal principles of success in the stock market and how to prepare for the crash in the stock market, which is, like I said, in my opinion, 1 year away. And so that's one way. The best way, if you want to stay updated with our top notch and highest priority ideas, is the newsletter. That's where we publish 3 times a week, and it talks about big picture economy, personal finance, and specific opportunities. After we've done a long research into a specific opportunity, then we publish the entire length of what we found, and so that's the entire congruent service.